Good afternoon. This is Josh here at Chaikin Analytics, and I'd like to welcome you to the 3 biggest mistakes investors make and how to profit from overcoming them. Our presenter today is Sandy Chaikin, co-founder of Chaikin Analytics. Chaikin Analytics is not registered as a broker-dealer or investment advisor, either with the U.S. Securities and Exchange Commission or with any state regulatory authority. Chaikin Analytics is for educational purposes only and is not a trade advisory service. Past results of any trading system or methodology do not guarantee future results. As a reminder, this webinar is being recorded and a copy will be sent to all registrants tomorrow. Be sure to submit your questions for the webinar using the Zoom Q&A window, which you can access at the bottom of your Zoom screen. Sandy Chaikin is co-founder of Chaikin Analytics, a groundbreaking stock research and analysis platform. With no prior experience, Sandy started investing in 2012 with Chaikin Analytics and built a killer portfolio that continues to outperform the S&P 500 and most money managers. Sandy is living proof that you don't have to be a financial expert to pick winning stocks. Thousands of investors attend her industry events and weekly webinars on fearless investing by following the Chaikin method. NASDAQ.com, Daily Worth, and Elevate all feature Sandy's investing articles and analysis. To get us started, here's Sandy Chaikin.
Hey, Josh, thanks so much. And thank you all for attending today's session on the 3 biggest mistakes investors make and how we can turn those around and actually end up profiting by overcoming them. So during the next hour, I'll be presenting the topic. And let's just give you a very brief background on me and why you should listen to me over the next hour. As Josh just said, since I started investing in 2012 as a novice, I have beaten the S&P 500 every year. And since 4 out of 5 pros underperform the S&P, by correlation, I've been outperforming the 4 out of 5 pros since I started with Chaikin. As you can see here from the stocks that I've listed, I've been invested in many triple-digit and double-digit stocks, including up through 2018, which was a pretty bad year for a lot of stocks, and 2019, which so far is pretty good. It's up 11% this year. But only 3% on a year-to-year basis. So when you look at some of the gains of stocks that I'm in or have been in of 41%, 90%, and another 40%, those are profits that any investor I would think would be happy to have. I only invest in 10 or 15 stocks at any given time, so there's not a big portfolio to manage, and I can do it pretty efficiently. So one of our biggest mistakes is letting emotions get the best of us. And Benjamin Graham is a well-known stock market wizard, really. He's known as the father of value investing. And after the 1928 crash, he basically wrote the textbooks on stock market investing. Warren Buffett, who we all ascribe to, describes Benjamin Graham as the second most influential person in his life, second only to his father. So here's what Mr. Graham says: the investor's chief problem and his worst enemy, or her worst enemy, is likely to be himself/herself. In the end, how your investments behave is much less important than how you behave. I mean, he's speaking directly to our emotions and, keeping those emotions in check, which is a lot easier said than done. I think we'd all agree to that, right? There's also something going on called loss aversion. And this is actually a well-researched fear that basically causes investors to sell winning investments early and hold on to the losers too long. It's been proven that our fear of losing is twice as extreme as the satisfaction of earning it. So, when you get trigger happy and look at something going down and think, oh my God, I don't want to lose any more money, I better sell this. Think of Benjamin Graham and keeping those emotions in check. And over the next hour, I'm going to show you how you can do that with very specific steps. Okay, so what are the 3 biggest mistakes we all have as investors? We follow the headlines. We react to volatility in the news. The tariffs are on, the tariffs are off, instead of a simple, repeatable process. Secondly, we fall in love with our stocks and wait too long to take the profits. Again, letting that fear of loss overtake us. We lack confidence. And when we're not investing or trading with confidence, we're not making great decisions. If we're making any decisions at all, sometimes we just freeze. If you don't have confidence, you do nothing. Do nothing isn't bad. Sometimes that's the best plan of action, but do nothing with confidence, knowing why you're not doing anything right now. But we can solve these. So let's get started. I always like to start a presentation looking at the overall market, because that obviously impacts each of our, the stocks that we're looking at or own. So this is the SPY. This is the index against which most investors measure themselves. Certainly I do. But you can see, since this low of what we call the December 24th massacre, down here at below like 235, we've been on a straight shot up. I mean, remarkably up to like 279, 280. Is there any sign that this is going to pull back again? Well, we've had a very strong earnings season. Both Mark and our chief market strategist, Dan Russo, feel like we're going to just keep moving forward, but we will have pullbacks. And the pullbacks are the opportunities to get into stocks, because right now most of them are pretty overpriced. But you do want to buy on those pullbacks. So it's important to have a disciplined methodology to follow, so that you know what your plan is when the moments present themselves. All right, a little bit more kind of general knowledge here, in that the S&P has grown an average of almost 10% a year over the past 20 years, but individual investors have only averaged 2.5%. And again, that's because, we're people, we're wired with emotion. It's very hard to dial out that emotion, but we do need to dial it out if we're going to be successful at investing, because we're drastically underperforming the S&P. All right, so what's mistake number one? Chasing the headlines instead of relying on a repeatable plan. So what we say is, just like when you're cooking or baking, you follow a recipe. We've got a recipe for success in the stock market, and it's important to follow that repeatable recipe for success and avoid following the headlines. Remember, the news people, and it's now, as we all know, 24/7, many channels are, constantly barraging us with financial news. They have to make you want to watch them. And, one way to do that is fear. You better listen to us, because, we know what's going on and you don't. But, that's not the way as a rule to follow the best path. So instead, we say follow an easy and repeatable process. And the outcome is likely to be like my outcome. These are stocks that I'm either currently in or have been in up till recently. And I show you the 1-year performance, anywhere from like 17% over year-to-year performance to 90%, where measured against the S&P of 3%. You can see it's many fold better. Those are the stocks that you want to be in, and out of the losers. So here's the process for investing success. You need tools that you can trust. I mean, if you're going to rely on something, you've got to know that it's trustworthy. You have to know how to identify those classic bulls, and you have to know how to avoid those classic bears, so that you can get out of them or not buy them in the first place. Let's start with tools you trust. For us, it's what we call the Chaikin Power Gauge rating. This looks like a very simple rating, doesn't it? This looks at a stock's likelihood to outperform the market over the next 3 to 6 months. I think of this as a GPS for stocks. It tells you where a stock is headed. And we have a Chaikin Power Gauge rating on each of the 5,000 publicly traded stocks. It looks very simple here, but it's not simplistic. Again, let me just repeat what it does, what it's analyzing. It's analyzing the potential of a stock to out or underperform the market the next 3 to 6 months. The rating itself is made up of 20 factors. They're rolled into these 4 components that you see headlined here: financials, earnings, technicals, and experts. And they give you an overall rating, as we see on Starbucks, of very bullish, and it goes all the way down to very bearish. But it's very simple to read, color coded, but it's a very complex algorithm going underneath the surface that's made up of these 20 individual factors. My husband, Mark Chaikin, researched over 220 factors when he was building this model after the stock market meltdown of 2008-09. And he, after a year or so of testing, he zeroed in on these 20 as being the most predictive in pointing towards the stock's potential to perform or underperform the market. So these are all rolled up. You can drill down and get a power gauge rating on actually any one of those 20 factors or any one of the 4 components, as you see on the far left for Starbucks, or roll it up to the very top of an overall rating, as you see here for Starbucks, a very bullish. So why are models better than us as humans? Well, again, let's go back to it's not our problem, it's just the way we're wired with emotions. But models beat human forecasters because they reliably and consistently apply the same criteria time after time, as opposed to human beings who are swayed by emotions and opinions. To give you a little bit of proof over our testing, both back testing and life-to-date testing, this was put into the marketplace in, I think it was 2010. If you only invested in stocks that we rate as very bullish, your portfolio would have been up an average of 10% a year. Remember, the S&P is up an average of about 9%, 10% a year over the last 20 years. On the other hand, if you only invested in very bearish stocks, your account would be down by an average of 0.5% a year. And neutral rated stocks would be like 7% a year, which isn't too far off from, the average stock. So it's not just me saying that the rating has validity. It is reliable. It's not reliable all the time. There is no such thing as a methodology or tool or model that's going to be 100% predictable and reliable, but it is reliable the majority of the time, about 70%. It's used by the pros, and we are also featured in many media articles, as you can see here, Forbes, Barron's, our partners, John Carter at Simpler Trading, and you can see Jim Cramer is a big fan of ours, and he and Mark do what they call fireside chats, one-on-one. I know many of you on today are from those fireside chat sessions. And then we were really honored in May to ring the bell on the NASDAQ exchange. We created 3 indices for NASDAQ back in 2013 that they asked us to create, overlaying the power gauge rating on their large cap stock, their small cap stock, and their dividend achiever stocks. So we did those, and those outperformed their benchmarks for the next 3 years, at which point we got the attention of New York Life Insurance, the largest mutual life insurance company in the country. Their investment arm, Index IQ, reached out and licensed those to create ETFs from the same methodology. We were then asked to come up to New York and ring the NASDAQ opening bell April 30th of this past year on the 1-year anniversary of the large cap stocks introduction, the CSML. So, oh, that's a small, CLRG. But in any event, it was very exciting, and it's not just us and individual investors, but it's the pros, and institutions are using the power gauge rating every day to make decisions for their clients. All right, let's go on to what to buy. We call it a classic bull, and you can see here it has certain components to it. And let's go to a stock chart. I think that's the easiest way to put these into play. Cadence Design is a computer software company. That industry group has been really strong this year. And what we do is read this chart from the bottom up. So for Cadence, you can start at the bottom, where you'll see this ribbon, green, mostly green, sometimes going to yellow, which is neutral, but that's the power gauge rating over the last year. And you can see pretty much since early January, power gauge rating has been bullish or strong. Right above it is relative strength. How strong is this stock doing relative to the SPY? Again, we go back to measure ourselves against the S&P 500. Because if you're not going to outperform the S&P 500 with the individual stock that you're about to buy, you'd be better off just buying the index and getting that 10% average a year return, which isn't bad. But if you want the 40, the 50%, the 90% returns on a year on a stock, this is the methodology to follow to find those. So relative strength, you want to be green. Green is good. I mean, it's basically all you need to know to read this chart is green is good, red is bad. And let's jump overbought, oversold. I'll come back to that. That's a great tool for timing. But right now, let's just look at what makes up a classic bull. On this mountainous range, I call this like chunks of mountains. This is the Chaikin money flow. This is the indicator which Mark created in, 35 years ago when he was creating tools on Wall Street for institutions. And this measures institutional money coming in and out of a stock. And basically this is what made Mark's name on Wall Street. It's Chaikin money flow, or CMF, or Chaikin oscillator, as it's sometimes called, is found on every charting system worldwide. Stockcharts.com, Bloomberg, really any charting package is going to have Chaikin money flow on it. And it's important because think of when you go to an auction or you're bidding on something at an auction. If there's a lot of people who want that item, what happens to the price? It goes up, right? Same thing in stocks. If there's a lot of institutions, like you see here since January, who want this stock and are buying this stock, it pushes the price up. Likewise, the reverse is true. And you can see back here in September, October at the red money flow with underperforming the SPY on relative strength and a neutral power gauge rating. Look what happened. The stock price falls. So I'm a big fan of money flow. If I don't see this big chunk of green going into a stock, it's not a stock that I want to buy into. You can wait till all these things line up perfectly. But this is what we call a classic bull. It has green power gauge rating, relative strength is strong, it's outperforming the SPY. Institutions are buying it, as you can see with this green Chaikin money flow, and the price is trending up. This orange line is a 200-day exponential moving average. These little white polka dot lines are what we call the Chaikin volatility bands. They typically house the movement of a stock. It's rare, like you see here, that it shoots way above it. Typically, they stay within this range. And they're a good guide as can help you decide when to buy and when to sell. Okay, it's equally as important to avoid the pitfalls, to know what to avoid, or if a stock you own starts breaking down and starts looking like this, that's your alert to say, hey, I better think about getting out of this stock. And it's basically the complete opposite of a classic bull. But let's go back again to Warren Buffett. Warren says, avoid risk whenever you can. And it's important to know that risk is part of investing and loss is part of investing. When I first started investing in stock, I'd like panicked if I had to sell a stock for a loss. But that's just part of the game. I now realize that that's part of it, and it's something we all have to accept. But we can avoid risk by following certain guidelines. And this helps me know when to time. I said I was going to go back to the overbought, oversold indicator. It basically charts this Wyckoff distribution chart, like what you see here. Now, Dr. Wyckoff taught stock market investing back 95 years ago, and he created this, and he did the reverse for when a stock is on the upswing. But it shows you that the price basically doesn't go straight up or straight down, right? It does this whole, I call it zigzagging. It goes straight across, it pulls up, it pulls back, and it jumps up again, pulls back, goes sideways. This is important to understand because this is what's happening to every stock that's falling. It goes through a similar pattern. You want to sell that stock on these yellow circles here when it's zigzagging up. You don't want to sell it when it's zigzagging down because inevitably it does always pop up a little bit. And knowing that this is the pattern that a stock price takes will really help you when you look at these charts. So let's apply that to Qualcomm. As you can see here, this is a classic bear. Okay, it's the reverse of a classic bull. Everything is red, right? Red power gauge since October. It's been underperforming the S&P 500 since November. And look at all this red money coming out. And look what happens when these three things basically line up, or at least two out of these three indicators line up. The price starts falling, right? Now, the power gauge went negative on October 8th at 71. You can see the stock is now 53. That's a heck of a lot lower than 71, right? The power gauge turning red was your signal to say, hey, you better get out of the stock. Also, you could see that the money flow, was negative since late September. So when you have a red power gauge rating, you still had relative strength to say it was outperforming. But if you have all this money coming out and this red power gauge rating, that's a good thing to say, I don't think I want to be in this stock. And these little red triangles are sell signals. Now we have 6 pairs of sell signals that are triggered by when certain criteria are met. The ones I've overlaid here are the money flow, which is saying, hey, there's a lot of money coming out of the stock. And again, down here in December and January and February, it's still saying, hey, there's a lot of money coming out of the stock. And you can see how the price follows that zigzag pattern. It zigzags across, it drops down, it goes across, it drops down, zigzags across, it pops up a little bit, pulls back. I mean, you get the picture. Look at the overbought, oversold indicator now. And this basically smooths out that Wyckoff pattern so that you can see when it's zigzagging up, as you can see here in December, that's when you want to take your buy. I'm sorry, that's when you want to sell a stock, when it's zigzagging up, as it did here in December, and again later December and later December. You don't want to sell it when it's down here in the 30 range, which correlates to here. You want to wait for it to peak up again. So if this were a stock that I owned now, you can see by it's now zigzagging up, hitting that upper volatility band, this would be a good time to sell this stock. if you're not already out of it. But our members would have been out on this back in October, probably October 8th, when Power Gauge turned bearish at 71. You don't want to ride these stocks down to 53, right? That's a losing game. All right, timing, holding stocks for too long. Whenever I ask the question in my presentations of what are your biggest challengers, the number one challenge for 70% of the investors is timing. They don't know when to get in and get out of a stock. It's a lot easier to get into a stock, and we have those green triangles to help you pinpoint those entry points. And we also have the red sell signals to help you pinpoint. But there's some other telltale signs as well. And let's go through those. So when to sell. There's basically two scenarios for when I sell. Either I'm taking a profit and I want to get my money out and say, thanks very much, this has been a good run. Or I'm sensing that the stock is starting to break down and I want to get out before a further loss. So let's break this down and look at selling to take a profit. There's a couple of scenarios for when to sell to take a profit. Price hits that upper volatility band. Remember I said on cadence, it's unusual for the price to fall outside of it. It's doing that now on some of these computer stocks because they are just so on a tear, but it's not normal. So when a stock hits that upper volatility band, it's often a good time to say, hey, this is the end. You know, this has been a really good run. It's not likely to sustain itself at this clip. Maybe I should get out and take my profit now. In line with that, you want the price to be overbought. Remember that overbought, oversold pattern that mirrors the Wyckoff chart. When it's zigzagging up, that's when you want to get out. That's when it's likely at the highest price. You don't want to sell it when it's down here. You want to wait. And the wait can be as little as 3 or 4 days. Patience is a virtue, they say, right? And selling on earnings spike. I've been making some really nice kind of fast profits by selling stocks when they spike on earnings. Now we've just ended our the last session of earnings, but when analysts estimate a stock as when they put estimates on a stock as to what price and revenue targets they think the stock should be making, and if the stock actually reports, which they're required to do once every quarter, if they report and they exceed that and they have good guidance saying, hey, we're looking 12 months out, things are looking really good for this. We think we're going to, exceed our sales quotas next year. That stock is very likely to spike, as you see it's done here. And that's when you can take a nice profit. That's when the money's coming in, money's pouring in because they're seeing, oh, this stock beat earnings. They're doing really well. I better get into this stock. But just like the auction, once they're on to another, the next day or 2 days later, they're on to a different stock, and that is very likely to fall back. So take your profit when you get those nice 10, 15% spikes on earnings. So let's look at a couple of examples of, and these are actually stocks that I have owned and have sold. So let's look at WellCare. Back in July, when I bought this stock at $252, I did so because it had a classic bull setup. Look at this. Green power gauge rating, persistently so, outperforming the SPY, and money flow was strong. And then I got a buy signal. I got this nice triangle here saying, hey, this stock is now oversold, meaning it correlates with this dipping down on the overbought, oversold. That's when you want to buy a stock. You don't want to buy the stock when it was up here or up here. You want to wait for these dips down. and this helps chart that for you. So I bought this stock here on July 25th at 252, and then I sold it up here at 319, which was a 52-week high. Now, how did I know to sell that at a 52-week high? Right? I mean, that's pretty nice, isn't it? I took a 27% profit in 6 weeks. Okay, so let's look at the chart. Let's look at what happened. It hit the upper volatility band, right? And I said it's not likely to stay above that. And as you can see, it didn't. It started curving down after October. But look, there's a little money starting to come out. And there's a pattern that we've identified that when you hit a 52-week high, power gauge is green, but money flow is negative. As you see this little bit of red coming out, that's a telltale sign that the institutions are selling. And it's smart to follow the money. If the institutions are selling, you want to be selling too, particularly when you take this nice profit at a 52-week high. So the stock is now at 256. It's down 20% from where I sold it, but it hit this low of 220 back in that December 24th. We call it the massacre, the Christmas Eve massacre, when everything dropped. But it went down to 220. I mean, how would you feel if you still own this stock at 220 when you could have sold it at 319, 100 points higher? I mean, that's a heartbreak, right? So that's why it's important to understand how to read this chart and to take the clues from it to get you out before it gets down to that point. All right, let's look at a second example of Amgen. This is another stock that I bought back in August, again on a buy signal, this time money flow buy. It was saying, hey, there's a lot of money coming into this stock. Jim Cramer loves this stock. He recommended it as a long-term pick. So I bought it back here in August because, again, I had the classic bull setup. I had green power gauge, relative strength was outperforming, and there was a nice chunk of money, institutional money coming into this. So I bought it on the buy signal. I took it up to the upper volatility band. And then I said, gee, it's unlikely to be maintained at this high level. I'm going to take my profit after 5 weeks. So I took my 6% profit after 5 weeks, sold it at the upper band. Again, it was a 52-week high. The stock was overbought. You can see here. And the next day, money started turning negative. And I said, phew, I made the right choice. And clearly, then it started to go against you. Stock's now at 190, almost 10% down from where I sold it. Okay, so how do you know when these signals trigger? I mean, you don't want to go through 5,000 stocks, right, looking for signals. But you don't have to, because we have what we call an alerts view, which I'm going to take you to the next slide, excuse me. But basically, we have these 6 pairs. I've been alluding to them: oversold or money flow. We've talked about both of those. You want to buy when the stock is dipping down like this on the overbought, oversold. You want to sell it when it's peaking up here in the overbought condition. Here's how you know when those signals trigger. This is the alerts view. You can overlay this alerts view on any list in your workstation. I have a list that you see here called my watch list. I also have one called my stocks. Obviously, the my stocks list includes the stocks that I own. Watch list is ones that I'm watching. And I want to know when a buy signal triggers on something I'm watching, because that could be a good time for me to buy the stock. I also want to know when power gauges have changed or estimate revisions have changed, and it gives me that news as well. As you can see, Salesforce.com CRM, the power gauge just turned green on that, And Magellan Healthcare, the estimate revision was just revised upward. Well, that's cool. I mean, these are things that can affect the price of a stock. So I want to know about these. And I can do this alerts view on any list. I do it every morning on my watch list and on my stocks list. And I look for things that may impact my decision to buy or sell a stock. I also get an email daily. I can sign up to get a daily email on my stocks as well as on the alerts in the SP 500. I get that every morning before the open. And as you can see, yesterday it told me that the rating had turned bullish for Viacom and for Salesforce.com. That's good to know. If there were any buy signals or sell signals that had been triggered, I would see it here as well. We do get a lot of testimonials from our members. Alex here says, we changed his life. I can't tell you how happy and grateful I am to have found Chaikin. I found you through Jim Cramer, and that is a day that's changed my investment life. So we want to change your life too and see you become more confident, profitable investors. Excuse me 1 minute. Okay, we said the second scenario for when I sell is if I'm sensing a stock is breaking down. So what are the telltale signs? Well, if the power gains turns neutral and another indicator like money flow turns negative, that gives me pause. Certainly if I get a sell signal, one of those little red triangles, or if the price drops below that orange line, that 200-day moving average, or that lower volatility band, that white dotted line that kind of, I'm a sailor, so I think of it as a channel. I always say this, but it's the clearest way I know to describe these polka dot bands. And I think of it because as a sailor, if you go outside the channel, you're likely to run aground. And I think of these volatility bands as the channel. It's not likely that the price is going to stay up above that. Likewise, if it falls below this, that's not a really good sign at all. You're in trouble with the stock. So that's a good place to say, hey, I better get out of this stock if I'm not already out of it. So let's look at a stock that that was breaking down, that I sensed was breaking down as well. Again, I bought this back when everything was green. I mean, I only will buy when it's a classic bull. Ideally, when I get a buy signal, as I did here, I got a money flow buy signal on April 24th at 32. Everything was green, classic bull, looks great. Chugged along, shot up like 18% on May 29th. It turns out they had announced a signed contract with Puerto Rico to complete their whole distribution electrical grid, that went out from Hurricane Maria. It was a huge contract. So the price jumped up. Point being, you don't need to know why it did. It just did. Take that as a gift and say, thanks, I'm out of here. I don't care what the reason is. 18% hike in one day is a gift. Take your profit, which I did. It also hit the upper volatility band. And look what's happening here with money flow. Money flow had already turned negative. So I was already getting the warning signs that, hey, this, institutions are selling. This may be a stock you want to get out of. And you can also see down here that the power gauge rating was kind of flipping back and forth from neutral to green. So, all was not calm in this house here. So you can see what happened. It did pull back a little bit, spiked back up again to a 52-week high late July. But then look what happened. I mean, then they really started breaking down when you see this big money flow coming out. Everything else being equal, money flows coming out. Typically, the stock will go sideways or down. And then when you see relative strength kick in with a negative power gauge rating and even more money coming out, look what happens to the price. So you can see how these color-coded indicators can really keep you out of trouble, can get you out before a breakdown. I mean, the stock is now at 23. It's down 40% from where I sold it at 38. You know, these prices, as you can see by the chart, they can drop precipitously fast. You know, it's not likely unless on an earnings report it will go up that high, but I mean, they drop quickly. They drop really fast and they can drop quickly. So you've got to be nimble, take the profit when you can, and say, thanks very much, I'm out of here. Let's look at one more stock example. And this again is NVIDIA. Okay, just move this one thing here. Okay, so power gauge, you can see power gauge turns negative in October 1st, actually, at 290. So that is right about up here. Yeah, right about up this upper volatility band, and it just started to turn. Stock is now 157, which is down 46%. You know, again, this is not something you want to ride down, right? Now, the interesting thing here is that Goldman Sachs recommended on 10/18, this was 2.5 weeks after power gauge turned negative, so it was right about in here at 240. They recommended a conviction buy. It wasn't just a buy. A conviction buy is this is our best stock that we can recommend as a buy. This is like really solid. So at 240, they're saying buy this stock. But if you look at this, as Chaikin members were able to do, there's a lot of red when that price is hitting 240. It was dropping to 240. Power gauge was red. Relative strength ticked negative shortly thereafter, but money was coming out. So if you had Chaikin, you would never dream of following that buy signal, but or that buy recommendation. You know, this is why it's so important that you have your own research so you can validate what you hear on the news or what you get, you know, in your feed. And you really, and Goldman Sachs is very highly regarded, right? I mean, it's one of the top firms, but they make mistakes too. That's why you have to have your own independent research so you can see these patterns yourself. So let's just summarize that again. Power gauge turned bearish October 1st at 290 at that first yellow arrow. And then Goldman upgraded it 2.5 weeks later to a conviction buy at 240, you know, when Chaikin members were selling. So everything you need to know to make a decision is right sitting on this chart in front of you. You don't need to reference many different services, newsletters, whatever. Really, everything you get is here, including news articles. I didn't go through that today, but we have news at the bottom of each chart on relevant news articles about each stock, and many more features than I've been able to cover here. But everything you need to know is basically on this one chart. Okay, so another one of our happy members, Norm, says, through following your excellent system, my portfolio now stands in excess of $1 million. Before Chaikin, I would make money and then lose it. Consistent earnings were just not a reality for me. Chaikin has changed all that. I can't thank you enough for your tremendous service and excellent methodology. So again, you know, you want consistent earnings, right? You don't want to be like a yo-yo up and down and all over the place. That's way too stressful. You need a reliable system that you can follow. And George here found a 10 times return in 5 days. He's an options trader. We have an options overlay for those of you who trade options. Josh, our webinar host, gives sessions on this to our members twice a week, anywhere from beginner to advanced. Members or options traders are welcome to join. But he says he paid for the subscription over tenfold in just 5 business days. All right, last mistake is that we lack confidence. But you really, in order to be a profitable investor, you've got to be a confident investor. If you're fearful, you're going to freeze. You're not going to be able to make decisions, or if you do, the decision is not likely to be a good decision. Interestingly, women in particular don't feel confident. The studies show that 72% of women don't feel confident making investment decisions, which is pretty frightening, right? I mean, that's the majority of women. Men, on the other hand, don't let their doubts stop them. They may have pause, but they tend to kind of soldier on, and can also lead men to making too many trades without enough analysis. So it kind of you can be overconfident and lose. You can be underconfident and lose. We want you to be confident with a sound system to back you up, so that you're not just a wild trader out there buying all sorts of things because you think you're a good trader. So our solution, in summary, is to rely on the process. Have the tools you trust, particularly the Chaikin Power Gauge rating. Know how to identify those classic bulls. Know how to identify those classic bears to avoid or sell, and certainly know when to sell. So you're either taking your profit when it hits those high marks, or you're sensing the stock is breaking down and you're getting out before you take a loss. And what's the point of all this? It's obviously we all want to make money, but we want to secure our retirement. So we want money to be stashed away for retirement, but you also want to enjoy your profits along the way. And what Mark and I do is we take vacations with some of the profits that I've made. So we like to go to Italy. We've gone to Turkey. We spent the whole month of October in Umbria, which is this bottom right picture right here, in this beautiful little lane, which was typical of all these lanes in this sweet little town called Spello in Umbria. But think about how you want to spend your profits, because it's more fun if you have a goal to work for, in my opinion. And then you can, you can see that little fund start to grow, and it will build on your confidence and give you more and more confidence to keep going. Okay, so our solution to all this is Chaikin Analytics. How to overcome those mistakes that we typically make. You've got to have a proven stock selection system that you can depend on. We typically sell Chaikin Analytics on an annual subscription for $2,195. As a webinar special, we're taking $300 off. This special offer is valid through Sunday night, midnight. But if you can sit tight, I'm going to make you even a better offer. Bonuses that we didn't have time to go into that are included in the workstation are a screener. You can, how do you find those classic bulls? Well, you can put the parameters of a classic bull into your screener and then screen for that, and it will filter out all the stocks that don't reach that. So you can take a universe of 5,000 stocks, literally in seconds, get it down to like 10 or 15 stocks. I mean, it's an amazing time saver and incredibly accurate. And every stock I buy is typically shown up on a screener. I referenced options. We have this options play overlay for those of you who trade options, and Josh will teach you how to do it. It gives you the 3 best risk reward scenarios, so you don't have to do all that manual calculation yourself. But I think one of our biggest assets as a company is that we offer small group tutorials so that you are up and running and know how to use the features, know how to set up your list, know how to add that alerts view over any list that you set up, and how you can trigger, look at those buy signals, know when they are triggering. This is unlimited, and we have member-only sessions. I think it's 3 times a week, because I know there's one tomorrow morning. So when you enroll become a member as early as tonight, you'll be enrolled tomorrow into this small group tutorial to help you set up and use the features. And this is unlimited. And if you find your particular trading methodology is unique enough that you feel like you need more hand-holding, you can set up one-on-one coaching with Josh or one of his colleagues. And that is unlimited as well and free. So, our success depends on your success. We want you to be successful. And we put an awful lot of effort, time and money into making sure that you are successful. So let's close with Jim Cramer. He says, if you don't use Mark Chaikin's work and Chaikin Analytics before you pull the trigger, well, you're going against 32 years of my work. He's referring back to the Chaikin money flow. He loves Chaikin money flow, as I'm sure you see him charted out every night on the CNBC show. So I told you I was going to make a little bit sweeter offer to you. We're taking an additional $100 off for a total savings of $400. Annual subscription for $1,795 a year. And that's if you join by midnight tonight. So I urge you to take action, become a member of Chaikin Analytics, and as early as tomorrow, you'll start building your list and starting your investment portfolio where you can really overcome these three most common mistakes we as human beings and investors tend to make. So, Josh, I'm going to turn this back to you to just end the session.
Sandy, thank you so much for your presentation today. Thank you, everybody, for attending today. I have put into the chat window, which you can also access at the bottom of your screen, the link to the offer. It will automatically be applied, so you don't have to do anything. You'll automatically get the great discount that Sandy's offering, or you can call us. If you have any questions, you can always call us, 877-697-6783. Again, that phone number is 877-697-6783. 83. As Sandy said, if you sign up tonight, you're going to hear from us tomorrow. We can get you on a small group session tomorrow afternoon. And if you can't make it live, we archive everything that we do. So you'll have immediate access to all the archives, Dan's morning note, our chief market strategist, Mark's weekly note, co-founder of Chaikin Analytics. Again, that number is 877-697-6783 or www.chaikinanalytics.com/Sandy. Thank you, everybody, and have a wonderful night.